let's begin our production budget. We're saying how many units do we have to produce in order to reach our sales goal? So we've completed the sales budget and the expected cash collection, but in order to reach those sales goals, we have to produce adequate units. So we'll look at our production budget as well as our desired ending inventory. Okay? So this says the management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. Again, the management at Royal Company wants ending inventory to equal 20% of the following month's budgeted sales in units. So we're saying that we want to always have inventory on hand. We want to always have an ending inventory. So on March 31st, the end of the first quarter, there were 4,000 units on hand at the end of the first quarter. We're now looking at our second quarter production budget, but keep in mind that you're going to begin with 4,000 units remaining from the first quarter. Okay? So here we have our budgeted sales in terms of quantity for the second quarter for the months of April, May, and June. Keep in mind that our ending inventory is going to be 20% of the sales for the upcoming month. So in the month of May, we expect to sell 50,000 units. Therefore, at the end of April, we want to have 10,000 units in an inventory. That 10,000 represent 20% of the expected sales for the following month. So, we need to produce 20,000 units for our April sales. We want to have 10,000 units on hand to equal 20% of our May sales, a total of 30,000 units. Now, we have 4,000 units already available. That was the ending inventory from the first quarter. Therefore, in the month of April, we need to produce a total of 26,000 units. Let's go over it again. 20,000 units are expected to be sold in the month of April. We want to keep on hand 20% of our next month's expected sales. We expect to sell 50,000 units in the month of April. 20% of that is 10,000 units. A total of 30,000 units are needed. We already have 4,000 units available, so we're going to produce 26,000 units in the month of April. Okay? So before I go to my next slideshow, let me ask you a question. What is the desired ending inventory we're going to put for the month of May? Again, what is the desired ending inventory for the month of May? If you said 6,000 units, then you would be correct. So I'll come back to this question here. So remember that your desired ending inventory is going to be 20% of your expected sale for the next month. In June, we expect to sell 30,000 units. 20% of that equals 6,000 units. So we need 56,000 units for the month of May. However, we already have 10,000 units remaining from April, because your ending inventory from April becomes beginning inventory for the month of May. Again, the ending inventory from April becomes your beginning inventory for the month of May. Therefore, we need to produce 46,000 units in the month of May. Okay? Take a look at our June. For June, the ending inventory represents 20% of our next month's sale, which is July. So the July sales are not shown on this budget, but remember early on they gave information. We expect to sell 25,000 units in the month of July. Therefore, 20% of 25,000 represents 5,000 units. So we need 35,000 units to be produced in the month of June. Now keep in mind again, we already have 6,000 units available, which was your May ending inventory. This 6,000 becomes your June beginning inventory. So we need to produce 29,000 units in the month of June. Okay, now let's put it all together for the entire quarter. For the entire quarter, we expect to sell a total of 100,000 units. Okay? Your desired ending inventory for the quarter, you look at the last month, is 5,000 units. That 5,000 represents 20% of the expected sales for the next month. Okay? Which means we need to produce a total of 105,000 units. However, we had 4,000 available at the beginning of the quarter. So the beginning inventory is here. On March 31st, we begin with 4,000 units at the beginning of the quarter. So subtract the 4,000 we already have available from what is needed. We're going to produce in the quarter 101,000 units. If you add these amounts from April, May, and June, the 26,000 plus the 46,000 plus the 29,000, they will total the 101,000 units. So for the second quarter, we're planning to produce a total of 101,000 units. To produce those units, I need materials. So next up, we look at our materials budget. All right. For the Royal Company, we need 5 pounds of material to produce 1 unit. Again, we need 5 pounds of material to produce 1 unit. We want to keep 10% of the following month's production on hand. So just like we want to have units in inventory, we also want to have material as part of an inventory. So we want to keep 10% of the following month's production on hand. So we're saying how much material is needed for the following month's production. We want to keep that amount on hand at the end of each month. Now, on March 31st, we had 13 pounds of material on hand. That was our March 31st ending inventory, 13,000 pounds. Now remember that the March 31st ending inventory will become your April 1st beginning inventory. Material cost is going to be 40 cents per pound. Let's prepare our direct materials budget. Okay? So these amounts here are coming from your production budget. We expect to produce 26,000 units in April, 46,000 in May, and 29,000 in June. You need 5 pounds of material to make 1 unit. So multiply 5 pounds times the number of units to get our production needs. So in the month of April, we need 130 pounds of materials in the month of April. Now remember that you want your desired ending inventory is going to be 10% of your production need for the upcoming month. Again, our desired inventory is going to be 10% of our production need for the upcoming month. So in the month of May, we need 230,000 pounds of material. 10% of that is 23,000 pounds. So take your production needs for the month of April, add in your desired inventory. So we need a total of 153,000 pounds of material in the month of April. Now keep in mind, we already have 13,000 pounds of material available from the end of March. Therefore, we're going to purchase in April a total of 140,000 pounds of material. We'll do the same process for the month of May. Again, your desired in inventory is 10% of your production need for the upcoming month. Add that to production needs for the current month. Then subtract from that your beginning inventory. And we're going to need to purchase 221,500 pounds of material in the month of May. So to not be redundant, we'll do the same thing for the month of June. In the month of June, we need to purchase a total of 142,000 pounds of material. So overall for the quarter, we're expecting production needs of 505,000 pounds of material. The desired ending inventory at the end of the quarter will be 11,500 pounds of material. So we need a total of 516,500 pounds of material. We had 13,000 tons of material at the beginning of the quarter. Therefore, we need to purchase a total of 503,500 pounds of material for this quarter. Okay, that's our purchase needs. Now, remember that every pound costs 40 cents. Again, every pound costs us, 40 cents. So we're going to multiply our material needs times that 40 cents to take a look at our cash disbursement. However, we're not paying for all the material each month because we can buy material on account, which means on credit. So one half of the purchase is paid for in the month of the purchase. The other half is paid in the following month. Again, we're going to pay for one half of the purchase in the month of the purchase. We'll pay the other half in the month following the purchase. The accounts payable account showed that we owed $12,000 at the end of March, at the end of the first quarter. So let's take a look at how to prepare next what's known as our expected cash disbursements. So again, these disbursements are based upon the amount of material we need for the months of April, May, and June. So up next, we're going to prepare our cash disbursements, okay? So stay tuned.